Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Micron.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to forget the Magnificent Seven for a minute. Just put them out of your mind.
Right, which is hard to do right now.
Exactly. But if you look over the past year, the absolute best performing AI stock on the market isn't some flashy name-making, front page headlines every single day.
No, it's a memory manufacturer.
Yeah, a memory manufacturer that is up 318%.
Wow.
318%. I mean, that is the kind of number that usually means a stock is trading purely on hype. Just fumes, right?
Oh, absolutely. It's a staggering return.
Yeah.
And, when you see a chart go vertical like that, your immediate psychological response is almost always regret.
Oh, totally. You look at your portfolio and you just think, well, I missed it. The train has already left the station.
Right. But our mission for today's analysis is to figure out if that assumption is actually correct for you, or if the broader market is fundamentally mispricing a multi-year AI catalyst.
Because we need to strip away the hype here.
Exactly. We're going to look at the actual financial ledger, investigate the physical mechanics of their competitive moat, and, really examine the imminent events on the horizon to see if this is still a viable wealth-building setup.
Right. And to do that properly, I feel like we have to start by addressing a massive historical irony here.
Yeah, the commodity aspect.
Exactly. Because for decades, memory chips were essentially the lumber of the technology sector.
Just basic building blocks.
Right. They're the most boring, low-margin, commoditized junk in the entire industry. You just bought whatever was cheapest.
Yeah, but the artificial intelligence revolution hasn't just boosted sales for this company. It's fundamentally mutated them from a commodity producer into this, exclusive luxury gatekeeper.
I love that framing, because a 318% gain demands some serious hard dollar justification.
Oh, for sure.
If we're looking for proof of that mutation from commodity to luxury, we really just have to open up their Q1 fiscal 2026 earnings report.
Which is just wild to read.
It is. Are we just seeing AI pixie dust here, or are there actual dollars backing this up? And, the numbers honestly look like a misprint.
They really do.
They reported a record Q1 with a 57% year-over-year jump in revenue.
Right.
And the bottom line gets even crazier. Adjusted earnings per share skyrocketed 167% to $4.78.
Which are just massive top and bottom line beats. But the real story, the actual proof that they are no longer just selling cheap digital lumber, is hidden in the margin expansion.
Oh, the margins, right.
Yeah, because their gross margins expanded massively. In a single quarter, they went from 38.4% all the way up to 56%.
Which is unheard of.
It is. And meanwhile, their adjusted operating margins hit 47%. And just to prove this isn't some clever accounting magic, the company generated $3.9 billion in adjusted free cash flow.
$3.9 billion.
Right. But here's the wild part. They generated that free cash flow even after taking $4.5 billion and reinvesting it directly back into the business.
In net capital expenditures.
Exactly. They're spending billions to grow their physical footprint, and they are still just drowning in cash.
Which sets the stage for their forward guidance, which is what we really care about.
Yeah, the future.
For fiscal year 2026, they are projecting earnings per share between $32.19 and $35.
That implies over 300% earnings growth.
Over 300%, alongside 109% expected revenue growth.
It's unbelievable.
Okay, let's unpack this for a second, because we can't just throw percentages around without explaining how this actually happens in the real world.
Right.
I'm trying to wrap my head around an 18-point jump in gross margins for a massive, mature manufacturing company.
It's not something you see every day.
Not at all. In the physical world, leaping from 38% to 56% gross margin practically overnight. It's like a factory that suddenly doubles its production volume and simultaneously realizes it has a line out the door so it can charge almost double for the exact same product.
That's a great analogy.
It's almost impossible unless you suddenly realize you have a complete monopoly on something everyone desperately needs.
And that is exactly what is happening here. It all comes down to a concept in computer science known as the memory wall.
The memory wall. Okay, break that down.
So for years, companies like NVIDIA have been making processors that are incredibly fast, right?
Right.
But those processors have a fatal flaw. They spend most of their time sitting idle, doing absolutely nothing.
Wait, really? The most advanced chips in the world are just sitting there.
Exactly. Because they are waiting for data to arrive from the memory chips. The processor is a genius, but it's constantly starving for information.
Ah, so as AI models get exponentially larger, that traffic jam between the processor and the memory becomes the ultimate bottleneck for the entire industry.
Precisely. And the solution to that physical traffic jam is what's driving these insane margins. It's a technology called high bandwidth memory, or HBM.
HBMs.
Yeah. And to understand why it's so valuable, think about traditional computer memory as a single, incredibly fast sports car.
Okay.
It can move data quickly. But if you need to move 1,000,000 people, or in this case, 1,000,000 data points for an AI model, that single sports car is going to take forever.
Yeah.
It doesn't matter how fast it drives.
Because it just doesn't have the capacity. You can only fit 2 people in the car at a time.
Exactly. High bandwidth memory, on the other hand, is like a massive 30-lane superhighway packed with high-speed buses.
Oh, wow.
It can deliver an astronomical amount of data to the processor all at once. So Micron isn't just selling storage anymore. They are selling the only solution to AI's biggest physical traffic jam.
So because the global AI infrastructure build-out is so desperate for this superhighway, the company is experiencing a perfect storm.
A total perfect storm.
They can charge significantly higher average selling prices, their shipment volumes are exploding globally, and they've maintained strict cost discipline.
Right.
That makes perfect sense. They have the cure for the bottlenecks, so they hold all the pricing power.
Yep.
But that brings up an obvious question for me. In the business world, 56% margins attract competition like blood in the water.
Oh, usually, yeah.
So if the margins are that spectacular, why don't competitors just flood the market with their own high-bandwidth memory chips, increase the global supply, and drive those prices right back down?
Well, because building that 30-lane superhighway is physically and technologically agonizing.
Agonizing. How?
It isn't something a competitor can just, spin up in a new factory. Micron is one of only 3 producers globally capable of making high-bandwidth memory.
Wait, only 3 on the entire planet.
Just 3.
Why is this so incredibly hard to make?
Because of how it's engineered.
Yeah.
To get that massive bandwidth, you can't just lay chips out flat next to each other on a board. You actually have to stack the memory chips vertically, like a microscopic skyscraper, sometimes 8 or 12 layers high.
Wow.
And then, to connect them, you have to punch thousands of microscopic holes straight through the silicon chips and run tiny wires down the entire stack.
That sounds insanely difficult.
It is. This process is so fragile, and the engineering tolerances are so impossibly tight, that the barrier to entry for new competitors is essentially insurmountable right now.
So they really are an exclusive gatekeeper.
Absolutely.
But, high bandwidth memory isn't the only thing they make. The underlying data also points to persistent structural shortages across their broader portfolio,
Right.
specifically in DRAM and NAND memory. So before we get into the shortage itself, can we just get a quick ELI 5, and explain I'm 5 on what DRAM and NAND actually are?
Sure.
Because the tech industry loves throwing these acronyms around interchangeably, and it gets confusing.
It really does. But it's a vital distinction. Think of a computer as an office.
Okay, an office.
DRAM is your physical desk. It's your
Yeah.
short-term working memory. When you're actively working on a project, or when an AI is actively training on a massive data set, all the documents need to be spread out on the desk so you can reach them instantly.
Right, they have to be right there.
Exactly. But when you turn the computer off, the desk gets cleared.
Okay, so DRAM is the high-speed workspace. Then what is NAND?
NAND is the metal filing cabinet in the corner of the office.
Ah, okay.
It's your long-term storage vault. It's slower to access, but when you put a file in there and turn off the lights, the file stays there permanently, where the AI saves its final trained models.
Got it.
And right now, we are facing a severe supply crisis in both of them.
In both the desk and the filing cabinet.
Yes. There is a confirmed structural DRAM shortage that is expected to last for the next 12 to 18 months.
Wow.
And the supply for NAND memory is expected to remain incredibly tight all the way through mid-2027.
Now, hold on. I have to push back on this premise just a little bit.
Okay, go for it.
Because historically, memory chips, whether we are talking about the desk or the filing cabinet, have always been cyclical.
Very cyclical.
We've seen this movie before, right? Demand spikes, Memory companies make an absolute fortune. They get greedy and overbuild factories. Supply gluts the market, prices crash, and those gorgeous margins evaporate overnight.
That is the traditional pattern, yes.
So why should anyone believe this time is structurally different? Why isn't this just the peak of another boom and bust cycle?
Well, that skepticism is exactly why so many traditional analysts are misunderstanding this stock right now.
Really?
Yeah. You are absolutely right that memory has traditionally been a highly cyclical market, but it was driven entirely by consumer tech upgrades.
Like people buying new laptops or smartphones.
Exactly, or gaming consoles.
Yeah.
But what we are seeing right now, isn't a consumer upgrade cycle.
So what makes the AI supercycle so different from the smartphone boom?
The sheer scale and permanence of the capital being deployed, the 12 to 18-month DRAM shortage, acts as a protective fortress.
Because there just isn't enough to go around.
Right. And because supply is so constrained across the board, Micron is actually using its technological edge to capture market share from rivals like SK Hynix.
Oh, interesting.
But the real structural difference is the enterprise data center demand.
Hmm.
Building out AI infrastructure isn't some seasonal consumer trend where someone buys a phone for Christmas.
Right.
It is a fundamental replumbing of the entire global computing ecosystem. This enterprise spending provides a massive multi-year floor for demand that previous laptop or smartphone cycles simply didn't have.
I see. And on top of that fortress, they have a geopolitical moat as well, right?
Oh, a massive one.
Because they benefit heavily from U.S.-based manufacturing advantages.
Yeah.
In today's climate, where everyone is terrified of supply chain disruptions in Asia, having domestic manufacturing ensures incredible resilience.
That's a huge selling point.
And their clients, the mega-cap tech giants building these billion-dollar data centers, they are more than willing to pay a premium for a secure, reliable supply of critical components.
Exactly. Supply chain security is no longer just an afterthought. It's a line item that commands a premium price.
Definitely.
And Micron isn't just resting on their current technology either. They recently formed a massive strategic partnership with Applied Materials and SK Hynix.
What's the goal of that partnership?
It's specifically aimed at next-generation memory development. This ensures they aren't just capturing the current shortage, they're actually designing the architecture for the next decade of high-performance computing.
So the underlying business is essentially an impenetrable fortress right now. You've got it secured by an AI supercycle, impossible engineering barriers, and severe supply shortages.
Exactly.
Which naturally brings us to Wall Street. How is the market actually pricing this fortress?
This is where it gets fun.
Right, because we have a company projecting 109% revenue growth. We have a company projecting 300% earnings per share growth.
Right.
Yet, despite all of that explosive triple-digit growth, the stock is trading at a forward PE, a price-to-earnings ratio of just 12.
A multiple of 12.
Wait, hold on. You're telling me a company tripling its earnings is priced like a dying brick-and-mortar retailer?
Earning much?
That mathematically makes no sense. If the fundamentals are this strong, who on earth is selling this stock at a multiple of 12?
It looks entirely broken until you realize how Wall Street's algorithmic models actually work.
Okay, explain that.
It goes back directly to your earlier point about cyclicality. Traditional financial models are programmed to automatically assign a very low PE multiple to memory stocks right when their earnings are highest.
Wait, why?
Because the algorithms look at the record profits and assume, based on decades of historical data, that the cycle is peaking and earnings will inevitably collapse next year.
So the computers are basically saying this is as good as it gets, sell now before the glut hits.
Precisely. Wall Street is still catching up to the paradigm shift. The automated models haven't figured out that the 12 to 18-month shortage and that permanent AI data center floor we talked about, those earnings aren't collapsing anytime soon.
Wow, so it's a systemic mispricing.
Yes. This has created a massive valuation anomaly. And while the retail market might be confused by the seemingly low multiple, institutional accumulation is happening right now, completely under the radar.
So the big money knows.
Oh, they know. Big, smart money is actively rotating out of the overly expensive software names and into these incredibly cheap AI enablers.
The company's providing the essential picks and shovels for the infrastructure build-out.
Exactly.
Which means there is a very specific window of opportunity for you before the broader market wakes up, realizes the cyclical algorithms are broken, and reprices that valuation anomaly.
The window is open right now.
So if we look at the calendar, what are the near-term events that could act as that alarm clock for Wall Street?
Well, we have several imminent catalysts. First, we have their Q2 earnings report. Consensus is already expecting record revenue, but the real test will be seeing if those gross margins hold strong above 56%.
Right, proving it wasn't a one-off.
Exactly. If they prove that Q1 wasn't a fluke, the market will be forced to adjust its forward models.
Then, right after that, we have the upcoming NVIDIA GTC conference.
Oh, that's a big one.
It's essentially the epicenter of the AI hardware industry. Any announcements made on that stage regarding next-generation high-performance computing will shine a massive, unavoidable spotlight directly on the absolute necessity of high-bandwidth memory.
It totally validates the entire ecosystem.
Yeah.
And then, on a macroeconomic level, we also have upcoming Fed meetings.
Right, interest rates.
If we see any signals of potential rate cuts, it lowers the cost of capital. That acts as a massive tailwind, fueling even more aggressive enterprise spending on data centers, which directly flows into demand for memory.
All of those catalysts are tangible and imminent. But, in the background of all this, there is a very loud rumor mill operating.
Oh, whisper numbers.
Yes. There is a speculative, unconfirmed whisper circulating among certain analysts right now that the stock could theoretically reach $1,189.
It's a huge number.
It's massive, and the math behind this rumor assumes that their fiscal year 2027 earnings per share hits $46.63.
Right.
Now, we have to be absolutely clear to you listening, that is a highly speculative model.
Very speculative.
But let's just look at the math for a second. If they actually hit $46 in earnings, a standard reasonable tech multiple of 25 times earnings puts the stock well over $1,000.
Yeah, the math checks out.
The fact that serious analysts are even modeling those numbers shows how violently compressed that current multiple of 12 really is.
It is speculative, but like you said, it is mathematically sound if the shortages persist. When you have a severe supply deficit colliding with an unprecedented technological arms race, the traditional valuation ceilings get completely blown off.
They just cease to exist.
Exactly. The market is slowly realizing that the ceiling is much higher than anyone historically thought possible for a memory stock.
But if you're looking at your portfolio right now, you can't just stare at the blue skies and the upside.
No, you have to look at the downside.
To truly build wealth and protect your capital, you have to understand the thunderstorms. We have to map out the threats that could derail this entire bullish setup.
Always.
So let's pivot to the risk assessment and look at the bear case. Where does this fortress crack?
Well, the most immediate risk is actually a negative feedback loop caused by their own success.
Oh.
Because memory chips are so expensive and incredibly scarce right now, it is squeezing the margins of the companies that manufacture standard PCs and laptops.
Yeah. Okay.
Think of the consumer hardware makers like Asus, HP, and Dell. To cover their rising component costs, those companies are going to be forced to raise the retail prices of their computers.
Okay, if I'm an investor, shouldn't I be terrified of exactly that?
It's a valid fear.
If a standard laptop suddenly costs 30% more at retail, regular consumers are just going to hold off on upgrading.
Yeah, they'll just keep their old laptops.
Exactly. And the consumer market is already stretched thin. Doesn't that kind of demand destruction directly hit the bottom line and validate the fears of a cyclical bust?
It is a very valid concern. And honestly, if we were analyzing this in 2018, it would be a thesis breaker.
But today...
But we have to clarify the risk balance in today's specific market environment. Yes, consumer PC demand might take a significant hit due to those price hikes. The consumer upgrade cycle might stall out entirely.
Okay.
However, the sheer volume of enterprise demand for high-performance computing completely eclipses the consumer market right now.
It's just that much bigger.
Way bigger. The billions of dollars of capital being deployed by mega-cap tech companies to build AI data centers more than offsets a slowdown in consumer laptop sales.
So the enterprise data center spend is basically acting as a massive shock absorber for any weakness in the consumer market.
Exactly.
It just swallows the excess capacity.
Right. The consumer market dictates the weather, but the enterprise AI market dictates the climate.
I like that.
However, there is a longer-term risk we must consider, which is competitive rotation risk.
Rotation risk, right.
Some analysts are looking further out and predicting that another AI hardware or software stock could eventually surpass the sheer momentum of companies like Micron and Palantir by the time we reach 2027.
The idea being that the market always hunts for the newest shiny object once the initial infrastructure is built out.
Exactly.
But how do you manage that risk if you are taking a position today?
You manage it through valuation. Rotation risk is always present in high-growth sectors. The reason that risk is entirely manageable right now is specifically because of that valuation anomaly we spent so much time dissecting.
The PE of 12.
Right. Because the stock has a forward PE ratio of just 12, alongside 300% EPS growth, you have a massive valuation cushion built right into the share price.
You aren't buying in at a nosebleed premium of 80 or 100 times earnings.
Exactly. Where any slight shift in momentum or a missed earnings whisper crushes the stock by 40% in a single day.
Right.
Instead, you are buying a deeply value-priced entry into hypergrowth.
The downside is protected by the cheap price tag, while the upside is totally exposed to the AI supercycle.
Exactly.
So let's bring this all together. Let's synthesize the financial numbers, the physical engineering moat, the imminent catalysts, and those manageable risks into a definitive, actionable investment thesis for you.
Right. Based on the complete fundamental and technical analysis, the official bullish score for this setup is a 9 out of 10.
9 out of 10.
Yep. If we were to distill this down into an elevator pitch, it is this. Micron is an incredibly undervalued, U.S.-based memory leader positioned for a record 2026.
Driven by the supercycle.
Yes. This explosive growth is being driven by an unstoppable AI enterprise tailwind, impossible engineering barriers in high-bandwidth memory, and massive confirmed structural DRAM shortages.
And crucially, we need to define the target horizon here.
Very important.
Because this is not a short-term trade designed to be flipped in a week or two based on headline momentum.
But definitely not.
The data points to a multi-year hold, stretching all the way into the fiscal year 2027 earnings acceleration. To summarize the core takeaway here, this is a remarkably rare opportunity to buy explosive, triple-digit earnings growth at a value stock price tag.
It really is.
It is almost unheard of in modern markets to find 300% growth trading at a forward multiple of 12.
I completely agree with that assessment. Buying the premier domestic memory leader during a confirmed multi-year structural shortage is just a textbook wealth-building setup.
Yeah.
The institutional algorithms might be confused, but the smart money is quietly positioning itself for this exact scenario, recognizing that the physical build-out of global AI infrastructure is still only in its earliest innings.
It really is a fascinating convergence. You have brutal supply constraints meeting a once-in-a-generation technological revolution.
A perfect storm.
It is. And as we wrap up today's analysis, I want to leave you with a lingering question to mull over as you assess the landscape of your own portfolio.
All right, what is it?
Think about the sheer physical scale of what we've unpacked today. We've established that the entire AI revolution is currently trapped behind a physical traffic jam, and high bandwidth memory is the only superhighway that can fix it.
Right.
If this specialized memory is truly the new oil fueling the entire global artificial intelligence economy, and there are only 3 major refineries on the planet capable of producing it,
Yeah.
what happens to the balance of power in the broader tech world if one of those refineries suddenly holds the exclusive keys to the smartest, most transformative technology on Earth?